This is the Flexible Office Economy, and I'm Mark Gilbreath. This week, we're talking about new platforms that are transforming commercial real estate and redefining the workplace experience. In particular, the way that traditional landlords are becoming active participants in the flexible office economy. My guest today is Ryan Simonetti, the CEO and co-founder of Convene, which defines itself as real estate's first workplace as a service platform. Ryan co-founded Convene in 2009 with his partner and longtime friend, Chris Kelly. Welcome, Ryan, and thank you for joining us today on the Flexible Office Economy.
Thank you, Mark. Excited to be on the line with you.
People like to know origin stories. Let's start with Convene's origin story. You've been quoted as saying, "What if we ran a building like a lifestyle hotel?" What led you and Chris to this question, and when did that kernel of idea first emerge?
So we'd have to go back a little bit. Convene, as you mentioned, we've been at this a long time now. I'd say, and Mark, I think you and I've talked about this, you were probably a little bit too early to the trend line. But the thesis actually, over the last decade hasn't really changed a ton. I think as a founder, I think your vision gets clearer over time, but the thesis that's actually underlied the business has been relatively consistent. So in a former life, I started my career at Lehman Brothers, great experience. I was always in love with business, but actually never had a true love or passion for real estate until my time at Lehman. And I think that was really born during my work there. I quickly realized that I wanted to be in a more entrepreneurial environment, while Lehman was kind of a leader in real estate. And it was an amazing place to kind of start as a foundation for a career. I knew I always wanted to do something on my own at some point. So I was kind of looking to get into a more entrepreneurial startup environment. And I was fortunate enough to join a company called Gramercy Capital, which was actually a subsidiary of that at that time of SL Green. And SL Green, as I'm sure most people know, is a very large, still probably the largest office REIT in New York City, and had been very successful. And the strategy for Gramercy was actually to invest both debt and equity across the country in all sorts of different asset classes. So you can almost think of us as really a generalist. And so I joined one of the investment teams there.
And that included,
was very fortunate.
Right?
Huh?
And that included hospitality.
Yeah. So it's interesting. So, I was a young guy, and I think one of the beauties of being in a growth company or a startup company is if you put your hand up, you always get picked. And so I was always putting up my hand to tackle new things. So I was able to get promoted quickly and ended up leading one of our investment teams. And while we invested in everything, and I've had kind of done transactions across asset class, I ended up spending most of my time in office buildings and hotels. Mm-hmm. And I was always fascinated with the difference in the conversation when you're with a hotelier and when you're with an office developer, landlord, or operator. Two very fundamentally different conversations. A hotelier thinks about creating value through human experience. And the better the experience, the higher the rate, the higher the occupancy, and the more profitability of the hotel. And an office developer is asking itself different questions, which is, how long is the term of the lease? What's the credit profile of the company signing that lease? How little capital do we have to invest in experience to create value, as opposed to how much capital do we have to invest to create experience? And it was something that stood out to me quickly. And, I kind of started to ask myself, well, what if you actually thought about running an office building like a hotel, where you put the user at the center of the value creation strategy, not the capital markets, not your investor, not your LP, and said, how could I create the best workplace experience within an office building? And what would the design of that be? What would the services be? What spaces would I need to bring that experience to life? And that was really the genesis, for Convene.
And let me
now,
there, if I may, I like how you sort of set the contrast between asset owner and hotelier. the customer that hotelier is trying to delight is the end user, the head that's laying on that pillow at night and that has the front of house experience when they walk into the hotel. And the customer for that asset owner is the individual that signs the lease, not the individual that walks into the building every day to do their work. To what extent do you think the commercial real estate industry is ready to think in those hospitality terms about actually serving the end user of the space, not just the individual at the corporation that signs the lease?
I'd say more open today than they were 12 months ago or 2 years ago. And at the time when we launched in 2009, I don't think any building owner really even understood what we were recommending that they do, or what we were doing, or the value that we would ultimately help create for them, because we were going to be able to deliver a better experience to their tenants and employees in the buildings in which we operated. So I'd say that there's definitely a shift in mindset that's happening in real time. But I would say that shift in mindset isn't being driven by desire to do it. It's more being driven by the fact that if I don't do it, I will not be competitive. And so I would actually question, is the reason the industry shifting to that model because it's actually the right thing to do? Or is the industry shifting to it because it feels it has no other choice? And I think if you look at the industry, I think there's different groups, some who fundamentally believe that the right thing to do is actually to put the human, the user, at the center, and to actually design your asset strategy, your design, your hospitality strategy, your amenity strategy around that end user experience. And I think there's other groups out there today that are doing it because they feel they have to. Because if they don't do it, they're afraid of being disrupted or afraid of being left behind.
Fear and greed can be powerful motivators. Is that okay? Will the owner that might be driven by that fear of being obsoleted by the shiny new object that's raised lots of capital and is creating hospitality experiences, can they get to the right same end place, or in terms of achieving what they need as a business model, or do they have to take on that mindset of a hospitality provider and really understand customer-centric thinking to get there?
Well, look, every landlord today, I think, realizes a few things, and you and I were talking about it before we started. If I take a step back and look at a company today, right? There is no question in my mind, and I think you share this as well in your mind, that the way that companies consume real estate has and will continue to fundamentally change.
Yes.
This idea of a landlord giving a box to a tenant saying, you go do everything, design it, build it, operate it, and oh, by the way, pay for it, and oh, by the way, commit to 5-10 years, which what you're asking that company to do is to predict with an incredibly high degree of certainty how many employees are going to work for them 5 or 10 years from now, what their business model may or may not be 5 or 10 years from now, what the design of their workplace is going to need to be 5 or 10 years from now, what their technology infrastructure is going to need to be 5 or 10 years from now. And I think most companies today that are a little bit progressive, big and small, have said, well, that fundamentally does not make sense.
Yes.
And if there was a way to consume that experience in a different, better way, please sign us up for that. And I think what you guys have done, what we're doing, what WeWork has done, what all of the industry, the coworking, service office, flex space, workplace as service, whatever you want to call it today, what we've identified is that there's actually a better way for a company to consume a real estate experience, right? And that is very much driven by flexibility. Underlying that, though, is actually a changing need of the underlying user, which isn't the person signing the contract with Convene, but the actual talent that those companies are trying to attract and retain. And so from a talent perspective, they also want flexibility, but more important than flexibility, they want choice and experience. And what they're asking from the company that they work for or from the building in which they inhabit is to start to provide more of experience and more of choice. To me, flexibility is a given today.
Indeed. Convene seemed to have identified somewhat early in its emergence that the enterprise consumer was its ideal customer profile. Is that true? Is that an accurate sort of reading of history?
Yeah, and it's interesting. I mean, some of that is because when I worked at Lehman, I was in the structured finance group, and I spent a lot of time doing CMBS deals, which are these bond offerings. And unfortunately, one of the things that you get trained as a finance guy is you start to obsess over credit. And if I think about what Convene has done versus maybe what some of the other co-working companies have done, is Convene has become an aggregator of corporate credit, right? If you look at our revenue stream, over 60% of our revenue as a company actually comes from enterprise companies with over $1 billion in revenue. And that's actually something we were focused on, that demographic, that segment in the market, literally since the first day that we started. Whereas if I look at some of the more traditional co-working operators, while enterprise has obviously been a growing part of that segment, for the most part, they're actually an aggregator of small business credit, which is a different credit profile.
Indeed.
So right or wrong, the credit guy in me led us down a path of really building an enterprise B2B outsourced workplace platform. We've just developed a competency in serving that demographic, which has allowed us, I think, obviously, to be successful in a lot of different ways. And it's also allowed us to expand our product offering over time, right? So when we first started, we were all about creating the best meeting experience and conferencing experience. That allowed us to build a hospitality infrastructure that allowed us to start to deliver hospitality amenities and services to building owner and therefore tenants in the building. And then workplace was actually a new product for us, but built off of the same foundation. And again, still serving that same end user customer demographic.
Let's linger on the enterprise a little bit longer. I think Convene should absolutely be credited with being one of the drivers, not the only, but one of the drivers that has led to enterprise real estate leaders being woke with regards to the opportunity of flexible office and co-working and all of its flavors. What's the most sort of binding constraint for your company, for Convene today, in terms of scaling to meet the extraordinary dimensions of enterprise demand that are emerging out there? What stands in the way right now for you?
Look, like most businesses, it's capital and resources, right? I think those are the two governors in every business. The biggest challenge for us right now is it's not a demand challenge. And I think there's a little bit of a misconception, I think, in our industry, maybe not so much for the folks that are operating within our industry, but people that are kind of on the peripheral, where they assume that companies like LiquidSpace and Convene and WeWork and Industrious are magically creating demand. That's actually not what we're doing. We're creating a new way to consume a workplace experience. And so just like Airbnb magically isn't making more people travel, it's creating a new way to consume a travel experience. To me, that's what companies like Convene are really doing. And so for us, it's less about creating demand. It's more about converting demand from what they historically would do, which is do everything on their own, right? Our biggest competitor still to this day is meeting held in-house or a workplace customer deciding to sign a long-term lease with a building owner and do it themselves. Yeah. Now, our real constraint becomes supply.
Yeah.
Right? And how can we bring enough supply online fast enough?
Yeah. And maybe a third suboptimal competitor is the suboptimal meeting that happens in the Starbucks or in the Cluttered Airport Lounge or somewhere not far away from a Convene location, but should have been at the Convene location to achieve what it could have been productivity-wise.
Yeah, and we think about those less as competitors and more as substitutes, and really being part of this third place infrastructure and ecosystem that's being built. And there is a place for the coffee shop in that, just like there's a place for Convene in that. And I think if the future state is what we started to talk about, which is fluidity, which is my ability as an employee of a company or as an individual to choose where I work, when I work, how I work, with whom I work, within which environment I work, that experience should start to feel consistent whether I'm in the coffee shop, I'm at a Convene, or I'm at my corporate HQ. And I think we're trying to build the infrastructure to start to enable that, at least within our own infrastructure at scale. The one thing I do want to point out, though, is when you said the biggest barrier to success for Convene, it's always been about the supply chain. And I think the difference between us and some of our peers is just like for Airbnb, it's the homeowner. And for OpenTable, it's the restaurateur. And for Uber and Lyft, it's the driver. For Convene, it's the building owner.
Yes.
And that's why we've always positioned ourselves as the landlord's partner, because if we can get them to convert a portion of their supply, 5% of their building, 3% of their building, 10% of their building, to the Convene branded experience, and do it in a way where we're not putting up all of the capital to do it, then we can technically bring supply online to meet the demand in a way that's more financially viable and resource viable, as opposed to trying to do what WeWork has done, which is raise so much money to just build literally your own supply chain without needing the landlord as a true strategic partner.
Lingering on that notion of getting Convene in the path of demand, perhaps in all the places where it wants to be, and recognizing that Convene, although you've not claimed it, I would suspect you've probably got the greatest penetration or percentage of your revenues coming from that high credit enterprise type client. There's only one other name that I think might be up there, but I suspect you're probably top of the heap. I'll give you that assumption. Where does the enterprise collectively want you to be? You're in what, 6 cities now, 20 locations? Were you able to address some of those constraints in terms of resource and capital? And those are solvable, of course. You're solving them.
Of course.
Where does the enterprise want you to be? Geographically, experientially, where does this look like in the not distant future as you take away some of those constraints?
Well, if you look at big companies and you look at typically the vendor networks that support them, you're going to notice that big companies, enterprise companies, tend to like to work with vendors that can support them wherever they are.
Yes.
Right. So when we talk to our enterprise customers, they're asking us to, relatively speaking, be ubiquitous, right? Meaning, can you be in every market that we need you? Now, then technically, as I would think about a TAM opportunity, which is we could be ubiquitous and be everywhere. And then you have to balance that with the reality of the business model, the unit economics, and how do you prioritize growth in a way that is smart and intelligent and enables you to be successful, not for 3 years, but for duration, right? Because I think we really, we want to build one of those companies that isn't here to play this structural change for 2 years and be gone. Like we literally are thinking 10, 15, 20, 25 years. And how do we build a sustaining business that is impacting the world, relatively speaking, and our customers at scale? So there's a balance between where your customer wants you to be and then where you should be, and when should you be there. Our strategy has been very much focused around core markets. So right now we have about 1 million square feet open. We're going to open up another almost 1 million square feet this year. We've got another 3.5 to 4 million in our pipeline, which will start to come on in 2020 into early 2021. And that's going to be primarily focused on the top 12 to 14 North America MSAs, as we would think about it. And that will also include London. So we're in 7 cities right now, including London. And then the plan is to be kind of in those 15 core markets at scale with our meetings product and workplace product within, the next, let's say, 24 to 30 months. The reason we're focused on those markets is for the products that we have at the price point that we have them, those markets support the business model that we have, right? And if maybe we weren't spending so much money on our product, if maybe we weren't delivering such a high-end experience, maybe if we didn't staff it the way that we did, we could be in more markets faster. we've kind of committed to delivering a true premium full service experience. And just like a full service hotel can't be in every market, Convene in its current form cannot be in every market. And we're okay with that today. That's not to say that we might not want to acquire or partner with somebody or launch something that would give us broader scale over time. But for now, that's really the strategic focus.
So recognizing that enterprises are a big part of your client base, not all, but certainly a big part of it, and maybe looking at the hospitality industry as an indicator of what the future might look like in the flexible office economy. We've got the Marriott Starwood sort of megaliths, and we've got the boutique hotels. And from my past lives in enterprise companies, enterprises tend to have their strategic relationships with a Hilton or with a Marriott for that ubiquity that you described as a need or a demand. Is that the future of a Convene? Does Convene become a portfolio ultimately that starts to see that level of scale? Or does it linger more in the boutique category with the ultra premium offerings in fewer but more upscale markets? What do you sense at this point?
Well, I'd say that there's two ways that I would answer that question. The one is, do we envision the future of the industry looking like the hotel industry, where you have multiple brands catering to customers and different segments of customers at different price points in different locations? I think the answer to that is yes.
JW Marriott.
Yeah, and do we believe that there will be 4 or 5 brands or platforms globally that have more scale than everyone else? I'd say the answer to that is yes. And if you look at the world today, clearly WeWork is going to be one of those companies. What remains or doesn't remain potentially of an IWG will be or maybe not be one of those companies, depending on what they decide to do corporately. Obviously they're looking at a lot of different strategic options corporately right now. And then we think that there's an opportunity for another 2 or 3 of those globally. I will say that that's our aspiration for sure, is to be one of these kind of dominant global brands. And within that brand is going to be a portfolio of other brands. And whether it's a portfolio of brands or a segmentation, like in the hotel industry, you have full service, you have resort destination, you have select service, you have limited service. Or if that literally becomes a collection of individual brands that speak to boutique, lifestyle, wellness oriented. My sense is for our industry, as opposed to hotel, it'll probably be less, because you're not selling to consumer, relatively speaking, you're selling to B2B, leaving the independent workforce aside, which will behave more like a consumer-driven market. So we definitely think that there's real parallels within our industry future state relative to hotel industry. I'll be honest, that's not too dissimilar from most industries where you have 3 or 4 or 5 global platforms that have meaningful scale, and then you've got a fragmented network of other providers that operate locally, regionally, et cetera, et cetera. Where this is a little bit interesting, though, is if you think about the total addressable market of what we're doing, it's a different TAM than the hotel industry. And the reason I say that is, and Mark, you and I have talked a lot about this. Today, about 3% of all U.S. office real estate is consumed as what we would all define as flexible, right? And that's serviced office plus service pre-built. That is a very, very low number if you believe fundamentally that the way companies consume real estate, back to that prior analogy of the box versus give me it delivered, if that's going to change. And I kind of think about like data center industry for this as a better example, right? It wasn't that long ago, you and I know, that every company had their own data center, and now nobody does, unless you're a cloud company. So if that 3% number is really going to be a 30, 40, or 50% number, then even a company like Convene with its offering can start to have massive scale in a given market. And I'll use an example. In New York City right now, by the end of this year, we will have 1 million square feet just in New York City. New York's, and that is no market share relative to the 3%. And it is nothing compared to 30, 40, or 50%, right? New York City is a many hundreds of millions of square foot Class A office market, which is our target category. So New York, for us, just as an example, we expect that in a market like New York, we could have 3 to 4 million feet of Convene inventory. Today we have 1 million. So we're just saying, even in a market just like New York, that's 4x potential growth. Yeah. So I think that is very different than what a hotel brand could say coming into a market like New York. Like literally, how many Sheratons are there in New York? How many Marriotts are there in New York? There's nowhere near the scale potential because we're really an outsourcing business.
Yeah, I mean, hotel market is gated by the growth in leisure travel and business travel. Real estate is poised at a point of inflection, or the flexible office economy is poised at a point of inflection where the fundamental deployment of dollars toward officing is shifting categories altogether, shifting from long-term leasing to as a service. And we think our point of view here at LiquidSpace is that we're actually in the early innings now of sort of the third chapter of the flexible office economy. Credit Regus and its serviced office peers for pioneering phase 1. Credit WeWork and Convene and a myriad of hundreds of other co-working operators that drove an inflection into phase 2. But as you sort of laid out, yeah, we're at 2 to 4% in most markets of absorption. And if it only just doubled to 6 to 8%, that would be incredible growth. But I think you and I and a number of other sort of forward-looking smart people are seeing 20, 30, 40, 50% type penetration opportunities in many markets. The scale of this is extraordinary.
Yeah, and I think on the scale thing, what's interesting is if you actually break down how office real estate just today, if you look at how it's segmented, most of the square footage in the country, and Class A, Class B doesn't matter, but just most of the office space in the country that's occupied is occupied by companies and teams that require less than 20,000 square feet. The bulk of that sits under 10,000 square feet. You could make a logical argument that if I'm a team and or company that needs less than 20,000 feet, there is no way in the world that I should be signing a lease longer than 2 or 3 years.
And the half-life,
because I have no idea where my business or my team will be, let alone 2 years from now, but 5, 6, 7, 8, 9, 10 years from now. Now, what's interesting is if you assume that whole segment of the market moves to flexible, the 3% number is automatically north of 30 or 40%, if not higher, depending on the market that you're in. Now, what's interesting is the question, well, who consumes everything else? Well, it's companies over 20,000 feet, but the bulk of that is actually controlled by companies with much larger footprint. Think corporate headquarters or large regional HQs. Now the question becomes, if I am PwC, JP Morgan, Google, Airbnb, et cetera, what percentage of my corporate real estate strategy, even in my HQ environments, should be outsourced? And what's interesting is we're doing some fascinating deals right now as a company, and it's actually a huge growth vertical for us right now that's kind of solving supply and demand at the same time, is we're doing these deals where we're literally integrating Convene into the HQ decision-making strategy of a large occupier, and they are literally designing us into their strategy, outsourcing us 50,000 feet, 40,000 feet, 100,000 feet of what they otherwise would have done on their own. So now I could say, well, maybe 20% of the whole HQ market becomes outsourced. Now I'm not talking about a 30 or 40% flex number. I'm actually talking about potentially a 50, 60 plus % number. And to me, I would say that if I fast forward a decade, that to me is a much more likely outcome than 8%, probability-wise, if I had to bet today. And that's not selfishly as somebody in the industry. That's like me just saying common sense would dictate that that's probably where you would end up. So it's an amazing time to be in the industry, in the sector like you and I are. And look, Mark, I mean, you've been a pioneer in this since day one. And all of us have gotten the benefit of your vision and the awareness that you brought to the market. So thank you to you as well.
Thank you. Let's come back to an important constituent that you touched on a couple of times, and we need to give, I think, further credit to, the landlord. And let me plug your annual predictions. And so folks do look up the Ryan Simonetti 5 predictions for 2019, because as always, year over year, he's pretty shrewd and on point with those. One of them was that,
at least one of them.
Yeah, well, one of the 5, we can talk about all 5. I agree with every one of them, but one of them was the prediction that landlords will either be partners or competitors in the flexible office economy. Let's unpack that a little bit, and I'd like to understand both your thoughts on how Convene is making a partner of landlords and vice versa. But I'd also like to probe a little bit. I'll have a follow-on question, but probe a bit about what about those landlords that are just doing it themselves. But start if you would with landlord as partner and Convene as partner to landlord.
Look, because of the change that's happening in the industry, every landlord today, and not just landlord, but their capital provider. So it's actually now moving past
Upstream,
the owner operator, literally upstream to the provider of capital and investor to the industry, is now saying, how do we respond?
What is your flexible
the
office?
Minute, yep. What is your flexible office strategy? What is your amenity strategy? What is your experience strategy in the building? That is, every capital and the provider in the world is asking that of their operating partner today in the industry, which is important to note. That is therefore forcing the industry to now, or the owners to say, we have to have a strategy, number one. And number two, we're probably, as part of that strategy, going to have to do something. Doing nothing, probably not an option for us and or our capital provider at this point in time, because risk of doing nothing is worse than risk of failing doing something. And then the question becomes, do I buy, do I build, or do I partner? And what's the structure in which I do any of those three things, right? Because I could partner and do it under a lease structure. I could partner and do it under something creative. I could partner under a management contract. And look, of the 1 million square feet we have open today, 30% of that is under a managed contract with a landlord. But all of those decisions are being made. In my opinion, the right thing to do, regardless of which structure you choose, is to partner. And the reason I say partner is I believe in the world that we live in, which is so much more complicated. Like, Mark, I don't know how you feel, but running our business today is more complicated at a macro level. Industry, market dynamics, competitive dynamics, technological change, labor market complexity than it was literally 12 months ago or 2 years ago. By far, moving at a pace that was not moving when we started 9 or 10 years ago. And the reason I say partner is because in a complex world, focus and core competency starts to become the only competitive moat that you have left. And I think that the landlord's core competency is not the LiquidSpace core competency, is not the Convene core competency. And building new core competencies, we having gone through that process of building technology as a core competency, is really, really painful, time-consuming stuff. And I do not believe that the landlord has the time to wait to build the competency to respond. I think the market's moving too fast. I think the complexity is too great, and focus and specialization is important.
Yeah, no, I agree with you. I wouldn't argue any of those points. That said, the picture is bigger than that to some degree. A number of major institutional owners have chosen to develop their own offerings. British Land with Story, their co-working offering. Tishman with Studio, of course. Boston Properties with Flex by BXP. In your estimation of some of those higher profile entries, are they doing something different and beyond what Convene would encourage them to partner on, or LiquidSpace might? Or do you think that they're perhaps venturing into deep waters that they don't fully appreciate?
I think the prediction of the 5, I think number 1 was landlord emerges as friend or foe. And then the next prediction was landlords who choose to go at it alone will struggle. And I would be disingenuous if I didn't stay true to my prediction. And no, my opinion is that the landlords who are going at it alone today are doing it in a very prototype-oriented fashion. My sense is they will find out that it is a different business than the one that they're in today, that it is a different set of competencies. And my gut would say that in the next 2, 3, 4, 5 years, I wouldn't be surprised if you see some of those assets that were created on behalf of building owners become part of maybe those other big platforms that we talked about through some sort of M&A or partnership-driven activity. I'd even make a wager that you'll see some of that in the next 12 months, if I had to be a betting man. So I would say that yes, the answer is deep waters. That's not to say that they're not going to be committed to prototyping and figuring it out. And I'll be honest, just because Boston Properties is launching Flex or British Land launched Story or Tishman Speyer, launched Studio, we're also doing deals with those landlords in other buildings. So to me, they're not committed yet fully to doing it on their own. They're preserving full optionality right now, because I think one of the challenges that the industry has right now, right or wrong, is who's going to win? Yeah. Who do I bet on today that I know, no matter what, is going to be here not 12 months from now, but 5 years from now, 6 years from now, 10 years from now? And I think one of the challenges that we have as an industry today is it's unclear, even to me being in the industry, who are all the winners going to be? Yeah. Because if I was a building owner making a partnership decision, I have to know whoever I pick as my partner isn't going to be gone 12 months from now. They couldn't raise money and therefore can't fund their business. So I do think that the natural risk aversion of a building owner is also forcing them not to be willing yet to fully commit to any one of these paths. But my hope is over the next 2, 3, 4 years, they fully commit. And our hope is that we become one of the partner beneficiaries to that commitment.
So Ryan, before we wrap today, let me play flexible office skeptic, and you can talk me back into optimism. You up for that?
Oh, of course.
So co-working spaces don't make money. So people are arguing that point. Enterprises will learn the co-working playbook, and they'll internalize those learnings to fix their culture and employee engagement problems. For landlords, higher CapEx, lower credit tenants, shorter terms, non-starter. Seems like to a pessimist or a cynic, there's a lot of reasons to maybe question the hype of the co-working story that's been so omnipresent in the business press. Can you pull me back to optimism?
Well, what's interesting is I'd say to all three of those things, yes, 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 right? There are many co-working companies today, and look, we get the benefit of looking at a lot of M&A activity, and there are a lot of companies out there today that aren't profitable, and they're not profitable at the unit economic level, which is different. And I think one of the things that has allowed us to raise as much capital as we have, to be such a partner of choice to really Class A operators and developers who, from a risk profile perspective, are actually the most risk averse in the industry, is our unit economics are better than everyone's out there, right? And I think unit economic profitability is something that at an industry level, the industry has to solve for, right? Now, the good thing is, back to the optimism side, to me, this is not too dissimilar from the early days of mobile. This is not too dissimilar from the early days of web, right? Which is now on to probably web 3.0. It's not too dissimilar from the early days of data center or cloud, which is the question that we have to ask ourselves is back to that. Do you fundamentally believe structurally that the way companies consume space today will and should be different in the future? And if the answer to that question is yes, then whatever happens over the next 2 to 3 years, which there will be a shakeout. I said in my predictions, I think 10% of all co-working companies will either be out of business or sold within the next 12 months. There will be a shakeout in the industry, just like there was in mobile, just like there was in web, just like there was in e-com, just like there was in payments, just like there's been in transportation, just like there is in travel online travel, right? Any of these big fundamental structural shifts, they have a life cycle. We still remain fundamentally committed and believe deeply that the future trend line, no matter what happens in the next 24 to 36 months, is what we're playing for. And I think unless you have that long-term view, you could quickly become a pessimist. So I would say the way that I think about it is short-term concern, not pessimism, but long-term faith and conviction in the scale and size of the structural shift that's happening from a real estate perspective.
Well, Ryan Simonetti, thank you. Thank you for your leadership in the flexible office economy. Thank you for your sweat, because you and I know as entrepreneurs, you don't get to
Oh my God.
And the industry is better for you, or better as a result of the work that you and your team are doing. Thanks for your time.
Thank you, Mark. Appreciate it.
This has been the Flexible Office Economy. Thank you for listening.